Treasury yields a little higher this morning after dipping post-Fed. They were up, they were down, back up again to 4.16 for the 10-year, the 2-year's at 3.53. And joining us right now with his insights on the bond market and the Fed's decision on rates this week is Mark Cabana. He's head of U.S. rate strategy at Bank of America Securities. And Mark, big week.
It was.
Heard a lot from the Fed. We're still trying to figure out what comes next. It's a split Fed at this point, and we're going to probably hear a lot more today, including from two of the dissenters.
Yes, it is a split Fed. It's a very divided Fed. They will tell you that this is not uncommon when you're at an economic turning point, but it does seem a little unusual to folks like us who follow the Fed closely and know that they try and limit the extent of dissents where they can. Now, we think it's going to be hard for them to sound too hawkish right now, just like it was hard for Powell to sound too hawkish on Wednesday, largely because there's still so much data that is yet to come. This is an unusual FOMC cycle period, in between meetings.
Because we didn't get the data because of the government shutdown.
Right. The government shutdown has backlogged the data, and we start to catch up in a big way, really starting next week. So you get
the jobs report.
You get jobs, you get CPI, you get retail sales. It's really a very rapid pace of incoming data. And so it's hard to guide too much at this point, not knowing what the official sector data shows.
There were some people who were suggesting the Fed should have put off its meeting until after they got this data next week.
That's right. But then it's a question of, well, do you put it off until next year? Do you wait for the data next week? Look, what we think is going to be most important to focus on in all of the data is the reading on the unemployment rate. As we know, they've been a little bit more concerned about the labor market for good reason. Hiring has slowed down. They don't know if that is a trend in labor supply or labor demand, so the unemployment rate really helps guide there. And what we look at when we look at their projections is that they only expect the unemployment rate to go to 4.5%. We were almost rounding up to 4.5% in the September data. And if we get any data that looks like the unemployment rate's going to 4.6% or, heaven forbid, higher as a result of that, it's going to be a very different tone that we hear from the Fed. So, again, you're going to hear from dissenters and say, no, we were right, we should have waited, inflation's still a problem. That's all well and good. But if we see the unemployment rate continue to deteriorate, which is indeed where it's been trending of late, then the Fed's going to have a hard time potentially pausing, and that is not what the market currently expects. The market thinks that the Fed is done. They think they're going to stay here for quite a while. But if the unemployment rate continues to tick up, then watch out, because rates are going to continue to drop from here.
It's fascinating because, yes, there was definitely this concern about the unemployment rate trending higher. But Powell also said that he sees a structural change in productivity growth, and the GDP estimates for the committee were revised higher. Market took heart in that idea, right? That they're not going to stand in the way of a higher GDP performance if, in fact, it comes without a reflation type move.
That's right. And he sounded a bit more optimistic, I think, to many on disinflation.
Right.
He's not terribly concerned about price levels where they are today. He thinks that once tariff effects roll out, you're going to continue to see inflation fall. And then whenever that happens, that should give the Fed the green light to keep cutting. But again, the risk to me is that you see the unemployment rate tick up, especially next week. And then the bond market's going to have to recalibrate with that. Now, if I can...
What would the recalibration be?
It would be a pulling forward of the timing of the rate cuts and then maybe cutting to below where the market thinks that the Fed is naturally going to stop, which is around 3% nominal.
And that would do what to short-term rates? It would do what to long-term rates?
It would steepen the curve, so short-term rates would come down by more. Long-term rates would probably nudge down a little bit. But you'd really see that the front end, what we call the belly of the curve, sort of the 5-year point, would move lower. And, that's an outcome that we currently know that several folks down in D.C. do want. Now, if I can, one of the other things that we saw that was interesting in the Fed this week is that they announced some large-scale asset purchases, in particular some bill buying. Now, we were very out of consensus in expecting this. The rest of the street thought that...
You did say a long time ago, I think we had you on in October, and you said you thought they were going to end quantitative tightening. And
they did, and then we thought that they were going to roll out bigger bill purchases, and they did. Clients told us they thought we were nuts, but we took heart in the fact that the Fed indeed acted to better anchor money market rates in the target range. Now, importantly, what you heard from the Fed, and you're going to continue to hear from the Fed, is that these bill purchases are not quantitative easing. They're not designed to remove duration risk from the market. They're not designed to signal anything about the future stance of monetary policy.
But they are designed to bring down longer-term rates.
The Fed will tell you that they're not. Their communications will say that they're not. However, we think it's important not just to view the Fed action in isolation, but to also view it in concert with what the U.S. Treasury Department has been doing. Because Treasury has been issuing a lot less at the long end than, let's say, that the recent Treasury secretaries might have otherwise done. They're issuing more at the front end through T-bills, and they're essentially, the Treasury is removing the amount of duration risk to the market, issuing at the front end. Now the Fed's going to be buying more of that. Should
President Trump stop complaining about Jay Powell all the time? He's doing everything he possibly can.
Well, look, I think that
to
the
get
Fed
the longer-term rates down.
I think that the Fed would tell you that they would love it if the president were to just let them be truly independent.
It sounds like he's working in concert with Treasury Secretary Bessent.
Now, I think what they would tell you and what Powell would tell you if you were able to ask him is that this is completely independent of that. I think the market is right to reflect some skepticism, but nevertheless, the combination of actions between the Treasury and the Fed, certainly all else equal, does modestly assist easing financial conditions. That should be a bit of a tailwind for financial assets.
But the fact that there was stress in the overnight funding market, a little bit, like they were very cognizant of the market seemed to be asking for this.
Look, I will tell you that the reason that the Fed took the action that they did had nothing to do with broader asset prices. It had everything to do with anchoring money market rates. However, the combination of the two and the desire for the administration and the Treasury Secretary to try and get long end rates down, it just fits really well.
So you're saying it is quantitative easing?
I'm not saying that, but I am saying that.
Look, in my mind, quantitative easing was mostly a psychological operation at the end anyway, and so that works in that direction.
I'm saying that the combination of the two does help ease financial conditions. It's mostly coming from the Treasury Department this time.
It's not quantitative easing, but it's easing financial conditions?
That I would agree with.
Parsing your words.
Right. Yeah, you know.